I'm sure you've heard the news about the shiny new thing in finance. It's called a CBDC. That's short for central bank digital currency. Now you might be wondering, what exactly is a CBDC and why should you care? Well, let me break it down for you. They're pitching it as the future of money, faster, cheaper, more efficient. Imagine a world where transactions are instantaneous, fees are minimal, and everything is seamlessly integrated into your digital life. Sounds pretty convenient, right? But hold on, there's more to the story. But as with most things that sound too good to be true, this is where the problems start. You see, while the benefits are being loudly advertised, the potential downsides are being whispered, if mentioned at all. Because what they don't tell you about CBDCs could cost you your financial freedom. Imagine a world where every single transaction you make is monitored, recorded, and potentially controlled by a central authority. Scary, right? So tonight, we're diving deep into the world of CBDCs. We're going to explore the hidden aspects, the parts they don't want you to see. We'll look at the implications for privacy, control, and the very nature of money itself. We'll expose who's really pulling the strings and what their plans mean for your money. Who stands to gain from this new financial system? And more importantly, who stands to lose? We'll uncover the potential dangers lurking beneath the surface, from constant surveillance to outright control of your spending. Imagine a world where your access to money could be restricted based on your behavior or social credit score. Brace yourselves, folks, because this is one rabbit hole you'll be glad you jumped down. We're about to embark on a journey that will open your eyes to the realities of CBDCs and what they could mean for our future. So stay tuned and let's get started. Experts like Dr. Jane Smith, a renowned economist, warn that CBDCs could lead to unprecedented levels of government surveillance. Imagine a scenario where every purchase you make, from groceries to a cup of coffee, is tracked and analyzed. This data could be used to build detailed profiles of individuals, potentially leading to a loss of privacy and autonomy. For instance, if you buy too much junk food, could your health insurance premiums go up? Or worse, could you be denied certain services? In countries with authoritarian regimes, the implications are even more dire. Imagine living in a place where your access to money could be cut off if you participate in a protest or speak out against the government. This isn't just a dystopian fantasy, it's a real concern. Cybersecurity experts also highlight the risks of hacking and data breaches. With all financial data centralized, a single breach could expose sensitive information of millions of people. The stakes are incredibly high. Imagine waking up one day to find your digital wallet empty, with no recourse to recover your funds. The convenience of CBDCs comes with significant risks that are often downplayed. So as we delve deeper into this topic, keep these potential dangers in mind. The future of money is being shaped right now, and it's crucial to understand both the benefits and the risks. Stay with us as we uncover the hidden agenda of CBDCs. Okay, first things first, let's break down what a CBDC actually is. CBDC stands for Central Bank Digital Currency. It's a digital form of fiat money, which means it's issued by a country's central bank. Unlike traditional money that you can hold in your hand, a CBDC exists only in digital form. But what does that really mean for you and me? Imagine your regular old money, except it exists solely as digital tokens floating around in cyberspace. These tokens are issued and controlled by, you guessed it, your friendly neighborhood central bank. This isn't some futuristic concept. It's something that central banks around the world are actively exploring and in some cases already implementing. Think of it like this. Your bank account balance is like having IOUs from your bank. When you deposit money, the bank promises to pay you back that amount whenever you need it. But a CBDC would be like having an IOU directly from the government. It's a promise from the central bank itself, not just a commercial bank. Now you might be thinking, hold on, isn't that kinda like Bitcoin or other cryptocurrencies? And you know what? You're right to ask. But here's the crucial difference. Cryptocurrencies like Bitcoin were specifically designed to be decentralized, free from government or institutional control. They give you the individual power over your own money. CBDCs? Well, they're the exact opposite. With CBDCs, every single transaction is tracked, traced, and potentially controlled by the issuing central bank. Imagine a world where every purchase you make, every bill you pay, and every financial transaction you engage in is monitored by a central authority. That's the reality we could be facing with CBDCs. But why would governments and central banks want to introduce CBDCs in the first place? One reason is to modernize the financial system. Digital currencies can make transactions faster, cheaper, and more efficient. They can also help reduce the costs associated with printing and distributing physical money. Plus, in a world that's increasingly going digital, it makes sense for money to follow suit. Another reason is to combat illegal activities. Digital currencies can be designed to be more transparent and traceable than cash, making it harder for criminals to engage in money laundering, tax evasion, and other illicit activities. But this increased transparency comes at a cost: your privacy. With CBDCs, the central bank could potentially see every transaction you make. They could know where you spend your money, how much you save, and even what you buy. This level of surveillance could be used to prevent illegal activities, but it could also be used to control and manipulate the population. For example, a government could use CBDCs to enforce economic policies. They could impose negative interest rates to encourage spending during a recession, or they could limit how much money you can save. They could even freeze your funds if they suspect you of illegal activities. This level of control is unprecedented and raises serious concerns about individual freedom and privacy. So while CBDCs might offer some benefits, they also come with significant risks. It's important to weigh these pros and cons carefully. On one hand, CBDCs could make the financial system more efficient and secure. On the other hand, they could give governments and central banks unprecedented control over our money and our lives. As we move towards a digital future, it's crucial to have open and honest discussions about the implications of CBDCs. We need to consider how they will impact our privacy, our freedom, and our financial system as a whole. It's not just about the technology. It's about the kind of society we want to live in. So the next time you hear about CBDCs, remember this: they're not just another form of digital money. They represent a fundamental shift in the way we think about and use money. And while they might share some superficial similarities with cryptocurrencies, they are fundamentally different in their design and purpose. Cryptocurrencies are about empowering the individual, giving you control over your own money. CBDCs, on the other hand, are about consolidating power at the top, giving central banks and governments more control over our financial lives. And if that doesn't send a shiver down your spine, it definitely should. So while they might share some superficial similarities, remember this: cryptocurrencies are about empowering the individual. CBDCs, they're all about consolidating power at the top. As we navigate this brave new world of digital currencies, it's up to us to stay informed and make sure that the future of money is one that benefits everyone, not just those in power. So what the hell is a CBDC anyway? It's a digital currency issued by a central bank designed to modernize the financial system and combat illegal activities. But it also comes with significant risks to our privacy and freedom. As we move forward, it's crucial to have open and honest discussions about the implications of CBDCs and to make sure that the future of money is one that benefits everyone. Now, let's dive a bit deeper into the technical side of CBDCs. At their core, CBDCs operate on a digital ledger, which can be centralized or distributed. A centralized ledger is controlled by the central bank, while a distributed ledger, like blockchain, is shared across multiple nodes, providing more transparency and security. In a centralized system, the central bank has full control over the ledger, which means they can monitor and manage all transactions. This setup is simpler and more efficient, but comes with the risk of a single point of failure. On the other hand, a distributed ledger spreads the control across multiple nodes, reducing the risk of failure and increasing transparency. Another key aspect of CBDCs is their programmability. Unlike traditional money, digital currencies can be programmed with specific rules and conditions. For example, a CBDC could be programmed to expire after a certain period, encouraging people to spend rather than save. This feature can be used to implement monetary policies more effectively. Comparatively, cryptocurrencies like Bitcoin operate on a decentralized blockchain, where transactions are verified by a network of nodes through a process called mining. This ensures that no single entity has control over the entire network, making it more resistant to censorship and fraud. However, the decentralized nature of cryptocurrencies also means they can be more volatile and less efficient for everyday transactions. CBDCs aim to combine the benefits of digital currencies with the stability and trust of traditional fiat money, providing a more reliable and efficient means of payment. In summary, while CBDCs and cryptocurrencies share some similarities, they are fundamentally different in their design and purpose. CBDCs are centralized, programmable, and controlled by central banks, offering stability and efficiency, but at the cost of privacy and individual control. Cryptocurrencies, on the other hand, are decentralized and empower individuals, but can be more volatile and less efficient. As we move forward into this digital age, it's essential to understand these differences and consider the implications of adopting CBDCs. The future of money is rapidly evolving, and it's up to us to ensure that it benefits everyone, not just those in power. Stay informed, stay vigilant, and make your voice heard in the discussions about the future of our financial system. Now, you wouldn't think handing over even more control of your money to governments and financial institutions would be a popular idea, would you? The very thought of it might send shivers down your spine. After all, we've all heard the horror stories of financial mismanagement, corruption, and the ever-looming threat of economic collapse. Yet, despite these concerns, the concept of central bank digital currencies, or CBDCs, is gaining traction at an alarming rate. It's almost as if there's a hidden agenda at play, one that's being orchestrated by some of the most powerful entities in the world. But why? What's the endgame here? And yet, here we are. The push for CBDCs is not just a passing trend, it's a full-blown movement. It's being marketed as the next big thing in financial innovation, promising to revolutionize the way we handle money. But let's take a step back and ask ourselves, who stands to benefit the most from this shift? Is it the average person on the street, or is it the financial giants who already hold the reins of power? So, who are the big brains pushing this brave new world of digital currency? It's not just a random collection of tech enthusiasts and financial experts. No, this movement is being driven by some of the most influential organizations on the planet. These are the same entities that have shaped global economic policies for decades, if not centuries. They have the resources, the influence, and the motivation to make CBDCs a reality. But what's in it for them? Well, buckle up, because it's a veritable who's who of global financial players. We're talking about organizations that have a vested interest in maintaining and expanding their control over the global financial system. These are the same players who have been at the forefront of every major financial shift in recent history. They have the power to influence governments, shape policies, and dictate the direction of the global economy. And now, they're turning their attention to digital currencies. We've got the International Monetary Fund, the World Bank, two of the most powerful financial institutions in the world. These organizations have a long history of shaping global economic policies, often with far-reaching consequences. They have the resources and the influence to push for the adoption of CBDCs on a global scale. But they're not alone in this endeavor, and let's not forget the Davos darlings themselves, the World Economic Forum, all singing the praises of CBDCs. And why wouldn't they? The World Economic Forum has long been a proponent of using technology to reshape the global economy. They see CBDCs as a way to create a more efficient, transparent, and inclusive financial system. But there's more to this story than meets the eye. CBDCs offer these institutions a level of control over global finance they've, frankly, only ever dreamed of. Imagine a world where every financial transaction is tracked, recorded, and analyzed in real time. This level of oversight would give these organizations unprecedented power to monitor and influence economic activity on a global scale. It's a level of control that goes far beyond anything we've seen before. We're talking about the ability to track every penny you spend, to know exactly where your money is going and how it's being used. This kind of data is incredibly valuable, not just for financial institutions, but for governments as well. It gives them the ability to monitor economic activity in real time, to identify trends and patterns, and to make more informed decisions. But it also raises serious questions about privacy and surveillance. To potentially freeze accounts they deem problematic, to cut off access to financial services for individuals or organizations that don't align with their interests. This kind of power could be used to stifle dissent, to silence critics, and to maintain control over the population. It's a chilling prospect, one that should give us all pause, and even to dictate how and where you can spend your own money. Imagine a world where your financial choices are limited by the whims of a central authority, where you can only spend your money on approved goods and services, and where your financial freedom is curtailed by the decisions of a few powerful entities. It's a dystopian vision, but one that's becoming increasingly plausible. So, while they'll talk about the supposed benefits of financial inclusion and efficiency, let's not kid ourselves. The rhetoric around CBDCs is designed to make them sound like a panacea for all our financial woes. But the reality is far more complex. These digital currencies are not just about making transactions easier or more efficient. They're about consolidating power and control in the hands of a few. This isn't about making your life easier. It's about creating a system where every aspect of your financial life is monitored and controlled, where your spending habits are scrutinized, your financial choices are limited, and your economic freedom is curtailed. It's a vision of the future that should concern us all. It's about consolidating their power and influence on a global scale. The push for CBDCs is not just about financial innovation. It's about creating a new world order where a few powerful entities have unprecedented control over the global economy. It's a vision that should make us all question the true motives behind this movement and consider the potential consequences for our financial freedom and privacy. Central banks around the world are also key players in this push. Institutions like the Federal Reserve in the United States, the European Central Bank, and the People's Bank of China are all exploring or actively developing their own digital currencies. Their motivations are multifaceted, ranging from the desire to modernize the financial system to the need to maintain control over monetary policy in an increasingly digital world. For these central banks, CBDCs represent a way to stay relevant in a rapidly changing financial landscape. With the rise of cryptocurrencies and other digital payment systems, traditional financial institutions are facing unprecedented competition. By developing their own digital currencies, central banks can offer a state-backed alternative that combines the benefits of digital payments with the stability and trust of traditional fiat currencies. But the implications of this shift go far beyond just offering a new payment method. CBDCs could fundamentally alter the way we think about money and financial transactions. They could enable new forms of monetary policy, such as direct stimulus payments to individuals or real-time tax collection. They could also make it easier to implement negative interest rates, a controversial policy tool that central banks have struggled to use effectively with traditional money. However, these potential benefits come with significant risks. The level of control that CBDCs would give to central banks and governments is unprecedented. It raises serious concerns about privacy, surveillance, and the potential for abuse. In a world where every financial transaction is tracked and recorded, the line between security and surveillance becomes dangerously thin. The potential for misuse of this power is enormous. Governments could use CBDCs to monitor and control the financial behavior of their citizens in ways that were previously unimaginable. They could impose restrictions on how money is spent, freeze accounts without due process, and use financial data to target political opponents or marginalized groups. The implications for civil liberties and human rights are profound. As we move closer to a world where CBDCs become a reality, it's crucial that we have an open and honest conversation about the potential risks and benefits. We need to ensure that the development and implementation of these digital currencies are guided by principles of transparency, accountability, and respect for individual rights. The future of our financial system and our freedom depends on it. Coming up after the break, we'll expose the true cost of convenience and why programmable money is about as appealing as a programmable colonoscopy. Stick around. Central Bank. Digital currencies, or CBDCs, have been touted as the future of money. But what are the hidden costs? Experts warn that CBDCs could lead to unprecedented levels of financial surveillance and control. Take, for example, the case of country X, where the introduction of CBDCs led to public outcry and protests. Privacy advocates argue that programmable money could be used to restrict personal freedoms and track every transaction. Financial experts also caution that the centralization of digital currencies could make economies more vulnerable to cyber attacks. As we delve deeper, we'll uncover more about the potential pitfalls and what you can do to protect yourself. Stay tuned for a comprehensive analysis of the risks and rewards of CBDCs. Welcome back. Now let's dive deeper into the history of digital currencies and how they evolved into CBDCs. Our journey starts in the early days of digital money. Long before Bitcoin made headlines, the concept of electronic cash was already being explored. In the 1980s, cryptographer David Chaum introduced the idea of anonymous digital transactions with his invention, DigiCash. Though it didn't take off, it laid the groundwork for future innovations. Fast forward to 2009, and we witness the birth of Bitcoin, the first decentralized cryptocurrency. Created by the mysterious Satoshi Nakamoto, Bitcoin promised a new era of financial freedom, away from the control of central banks and governments. Its success spurred the development of thousands of other cryptocurrencies, each aiming to improve upon or differentiate from Bitcoin. But with the rise of cryptocurrencies came concerns about regulation, stability, and security. Enter central bank digital currencies, or CBDCs. Unlike decentralized cryptocurrencies, CBDCs are issued and regulated by a country's central bank. The motivations behind their development are multifaceted: a desire for more efficient payment systems, increased financial inclusion, and, of course, greater control over monetary policy. As we explore the evolution of digital money, it's crucial to understand the context and significance of CBDCs. They represent a significant shift in how we perceive and interact with money, blending the innovations of cryptocurrencies with the regulatory oversight of traditional banking systems. Stay tuned as we continue to unravel the complex world of digital currencies and their impact on our future. In this chapter, we'll examine the potential benefits of central bank digital currencies, or CBDCs. First and foremost, CBDCs have the potential to significantly improve financial inclusion. In many parts of the world, access to traditional banking services is limited, leaving millions of people unbanked. By leveraging digital technology, CBDCs can provide a secure and accessible means for individuals to participate in the financial system, regardless of their location or socioeconomic status. Another key advantage is the reduction in transaction costs. Traditional financial transactions often involve multiple intermediaries, each taking a cut of the pie. With CBDCs, transactions can be streamlined, reducing the need for intermediaries and consequently lowering costs for consumers and businesses alike. This could make everyday transactions, from paying bills to sending remittances, more affordable and efficient. CBDCs also promise to enhance the overall efficiency of the financial system. By digitizing currency, central banks can improve the speed and reliability of payment systems. This can lead to faster settlement times, reduced risk of fraud, and greater transparency in financial transactions. For instance, programmable money can be used to automate complex financial processes, ensuring accuracy and efficiency. To better understand these benefits, let's look at some real-world examples of CBDCs in action. In China, the digital yuan has been piloted in several cities, allowing residents to make digital payments seamlessly. The European Central Bank is also exploring the concept of a digital euro, aiming to enhance the efficiency and resilience of the financial system. These implementations provide valuable lessons on the potential and challenges of CBDCs, offering insights into how they can be effectively integrated into existing financial frameworks. As we continue to explore the world of CBDCs, it's clear that they hold significant promise for the future of money. By improving financial inclusion, reducing transaction costs, and enhancing system efficiency, CBDCs could play a vital role in shaping a more inclusive and efficient global financial landscape. Stay with us as we delve deeper into the implications and future prospects of digital currencies. Now, let's explore the potential risks and downsides of CBDCs in more detail. While the benefits are promising, it's crucial to consider the other side of the coin. One major concern is privacy. Unlike cash transactions, which are largely anonymous, CBDCs could allow for unprecedented levels of surveillance. Every digital payment could be tracked and monitored, raising significant privacy issues. This has led to fears that CBDCs could be used as tools for government overreach, with authorities gaining the ability to scrutinize and control individual financial behaviors. Another critical issue is the impact on traditional banking systems. The introduction of CBDCs could disrupt the current financial ecosystem, potentially leading to a decline in the role of commercial banks. As people move their funds into central bank digital currencies, banks might face liquidity challenges, affecting their ability to lend and support economic activities. Furthermore, the implications for individual financial freedom and autonomy cannot be overlooked. With programmable money, governments could impose restrictions on how and where money can be spent. This could limit personal freedom and lead to a more controlled and regulated financial environment. For instance, consider a scenario where a government decides to restrict spending on certain goods or services deemed undesirable. This could infringe on individual rights and freedoms, leading to a society where financial autonomy is significantly curtailed. As we weigh these risks, it's essential to approach the implementation of CBDCs with caution. Robust safeguards and regulations must be put in place to protect privacy, ensure the stability of the financial system, and preserve individual freedoms. Stay tuned as we continue to unravel the complexities of CBDCs and their implications for the future of money. In this chapter, we'll hear from experts and thought leaders on both sides of the CBDC debate. We'll present a balanced view of the arguments for and against CBDCs, allowing viewers to form their own opinions on this complex and controversial topic. Cut to Expert 1. Expert 1. CBDCs have the potential to revolutionize the financial system, providing greater efficiency, security, and financial inclusion. They could reduce transaction costs and make it easier for people to access financial services, especially in underserved areas. Cut to Expert 2. Expert 2. However, we must be cautious. The introduction of CBDCs could lead to significant privacy concerns. Unlike cash, digital currencies can be easily tracked, which could pave the way for increased surveillance and government overreach. Cut to Expert 3. Expert 3. Another advantage of CBDCs is the ability to implement monetary policies more effectively. Central banks could respond to economic crises more swiftly, providing direct stimulus to individuals and businesses. Cut to Expert 4. Expert 4. But there's a flip side. The widespread adoption of CBDCs could disrupt the traditional banking sector. Commercial banks might face liquidity issues, which could impact their ability to lend and support economic activities. Cut to Expert 5. Expert 5. One of the most exciting prospects is the potential for programmable money. This could enable innovative financial products and services tailored to individual needs and preferences. Cut to Expert 6. Expert 6. Yet programmable money also raises concerns. Governments could impose restrictions on how and where money can be spent, potentially infringing on individual freedoms and financial autonomy. As we can see, the debate surrounding CBDCs is multifaceted, with compelling arguments on both sides. It's crucial to consider these perspectives as we move forward in understanding the future of digital money. Stay with us as we continue to delve into the world of CBDCs and what they mean for our financial future. As we wrap up our exploration of central bank digital currencies, it's time to gaze into the future and consider the potential long-term impact of CBDCs on the global financial system. What could a world dominated by digital currencies look like? Firstly, let's consider the possible scenarios. In one scenario, CBDCs could lead to a more inclusive and efficient financial system. People in remote areas could access banking services with just a smartphone. Cross-border transactions could become instantaneous, reducing the friction and costs associated with international trade. However, another scenario could see increased government control over financial activities. With the ability to track every transaction, authorities could implement policies directly through the currency itself, potentially leading to a loss of financial privacy and autonomy. For individuals and businesses, preparing for a world where CBDCs are the norm involves staying informed and adaptable. It means understanding the technology and its implications, and being ready to embrace new financial tools and services. In the end, the future of CBDCs is still being written. It will be shaped by technological advancements, regulatory decisions, and societal attitudes towards digital money. Whether we view them as a revolutionary step forward or a potential risk, one thing is certain. CBDCs are set to play a significant role in the future of finance. Thank you for joining us on this journey through the world of central bank digital currencies. Stay tuned for more insights and updates on the ever-evolving landscape of digital money. Stay informed, share this video, and take proactive steps to protect your financial freedom. The future is in your hands.